All right, good morning. Good morning. This is Byron Sweeny with Byron Sweeny Insurance Brokerage. And today, in this episode of Insurance 101, we're going to talk about term insurance and some of the misconceptions about term and also the type of term that you should have as long as it fits your monthly budget. So, with term insurance, your traditional term, meaning that you may have a 10-year, a 15-year, a 20-year, a 25, or 30-year term. If you have $100,000 coverage in a 30-year term, meaning that if anything happened to you within that 30 years, you get the full coverage of 100,000, 200,000, 300,000, or however much coverage that you have. If you outlive that term, the policy goes away, the coverage and the policy goes away, and all the money that you spent into it goes away. You just had coverage from that time period. If something would have happened during that time period, you would have got the full coverage. Now we'll talk about what is called renewable term. So renewable term is the term that most people talk about when they talk about the misconceptions, meaning that if you're getting a policy for $100, $200, $300,000 and you're paying $12 a month, $15 a month, $20 a month, more than likely is going to be some type of renewable policy, meaning that if it's a 20-year term, renewable policy, it may renew every 5 years. So the first 5 years you'll be locked in at whatever your premium rate is, and then at the end of that 5 years you'll get an increase, and then the second 5 years you'll be locked in at whatever that premium rate is, and then at the end of that, basically 10 years, you'll get an increase, and then so on for 15 years, an increase, 20 years, an increase. Now the problem with renewable term is that once you start receiving that increase, it's going to be significant. It's going to be significant. The first increase in the first 5 years may not be that bad, but it's going to end up being significant because once you reach at least 75% of whatever your term period is, meaning if you got a 20-year term and you reach 15 years, your policy is going to more than quadruple by the time you reach that 75-year period, meaning that most people end up dropping that policy because it just become unaffordable. You started off paying $22, then that went from $22 to $52, that went from $52 to $80, and then it goes from $80 to $260. So most people end up dropping that policy for the most part because they didn't understand that they was on a renewable policy and the agent didn't explain it to them the correct way. All they saw was, I'm paying $12 for $100,000, $200,000 that more than likely you'll never see. So what you want when you go with term, you want what they call as a fixed rate level benefit. That means that if you get a term policy for whatever term period, 20, 30 years or whatever, you're going to be locked in at that fixed rate level benefit, no increases during the entirety of that term period. That's what you want to aim for. But if you have an option, you want to add what they call as a return of premium or a cashback option to that term, a return of premium, ROP, or a cashback option, CBO, to that term. What that means is if you add that cashback option or return of premium, it locks it in similar to a whole life policy, meaning that now it has a cash value. Now, what that means is if you have a 30-year term with a ROP or a CBO option on it, if you outlive that term, you get all your premiums paid in or your cash that you paid into that policy back at the end of the term. So it's what I call as a win-win policy. So, of course, it's going to be a little more expensive than regular term, which is that fixed rate level benefit. It'll be more expensive than that, but it's worth the option. It's worth the option because you want to look at, do I want to pay $5 or maybe $10 more a month to get something back at the end of the term? If you have a 30-year term, $200,000 policy, and you paid over 40 grand in it, and once it go away, you just lose that 40 grand. I think that, you should add that return of premium or that cashback option, so you can get that money back at the end. You can get that money back at the end, and it's a win-win, and you can actually turn that into its own whole life policy. Now, when it comes to that cashback or return of premium option, all companies don't offer it. There's very few companies out there that do offer it. So when you're sitting in front of an agent or broker, you want to ask them, do y'all offer level benefits / fixed rate term policies? And also, do y'all have a return of premium ROP option and a cashback option CBO? Because you want to add that CBO option, cashback option, return of premium to the end, to that term. Because that means that if something happened to you, if you have a $200,000 term policy for 30 years, something happened to you within that term, you get the benefit amount. But if you outlive that benefit, you get whatever your return of premium is in that policy. And most agents can tell you an estimate of how much that return of premium will be at the end of the policy. Now, they can't give you an exact amount because, of course, when you go into an insurance policy, you're locked in at an interest rate, and you're guaranteed to receive no less than that interest rate that you're locked in. But you may receive more than that interest rate at some periods during that term period. So you may receive more money than you usually would at your locked in fixed rate that you got as far as the interest rate. So they usually should give you an estimate of what your return may be at the end of that policy. That concludes this episode of Insurance 101, where we discussed the misconceptions of term. But all term is not bad. All term is not bad. Now, the type of term you get can be bad for your situation, depending on your age and your health issues. And for the most part, if you get a term policy, you want to shoot for a 30-year term. You don't want to get a 10-year term because if you're a 56-year-old and all you qualify is a 10-year term, but you can't add that CBO option or that return of premium option, but you do qualify for some form of term, that means that you're in good health. You're in decent health, so you're more than likely going to outlive that 10 years, because if your health wasn't that good, you wouldn't qualify for a term policy. Check my links below, like my YouTube page or follow my YouTube page, and follow my Facebook business page for more information on insurance and Insurance 101. Thank you.